Thank you very much.
Mhm.
I'm very pleased to be here today and give this final presentation for the Egg Outlook webinar for the winter series that our department has put together. Um, so, as Kelly mentioned, I'm the Farm Income Enhancement Chair, and the Farm Income Enhancement Program does research and outreach on U.S. agricultural issues. In this presentation is jointly developed with my PhD students Siddhartha Bora and Cashin Deng. So with that said, today I will provide an update to the presentation that was given last November and provide the outlook for 2021. So several themes I will cover today. The first one is U.S. net farm income and net cash income are forecast to decline in 2021, but even so, they are still expected to be above their long-term average. The decline in farm income is mainly driven by lower expected government payments and crop inventory, although we expect to see some higher crop and livestock cash receipts. I will also discuss long-term farm income and commodity price projections, which show stability after 2 or 3 years. I will cover land values, cash rents, which have shown small increases in 2020. And finally, I will end up with financial stress, and I will talk about ag loan delinquency rates and bankruptcy rates, which have had recent upticks and downticks, but have remained relatively low recently. So let's start with U.S. farm income. As Secretary Vilsack has recently mentioned, farm income is one of the top priorities of USDA for 2021, improving farm incomes and particularly reducing the reliance of farmers on off-farm income and shifting more toward farm income. So, what is the most recent USDA forecast for farm incomes? Um, so, USDA is predicting that U.S. net cash income will be $128 billion and net farm income would be $111 billion. And they're forecast to decrease by about 5.8% and 8.1% respectively in 2021. So as we're seeing here, we're coming from the very high years of farm income. Then we went to an agricultural downturn. We ended up on a higher note last year due to higher government payments. And again, we are seeing an expected decline for this year. As I will talk about later, our research is consistent that we published last year. We're showing that this February forecasts are actually consistently about 10% lower than what farm incomes actually happen to be at the end of the year using historical data. So if the same trends continue, it's likely that we actually may see a little bit of higher farm incomes for 2021 than what USDA is currently projecting. Now, to compare with the Ohio farm income estimates, the last estimates that we have available are for the calendar year of 2019. We don't have any estimates yet for 2020. Very surprisingly, Ohio had a reduction in farm incomes in 2019 when US actually posted an increase. So typically, Ohio farm incomes are about 2.1% of the US farm incomes, but they actually have higher volatility over the last decade. So if historical trends continue and USDA is projecting a slight decline of farm incomes this year, it's very likely that we would have the same expectation for Ohio farm incomes, which is of declining farm incomes. Now, looking in terms of real net farm income, and all of this is for the US, this is the um, net farm income over the last 70 years. And if this is the average, we actually see that the incomes that we have had in the last couple of years are still above their long term averages. But the Ohio real net farm income that was in 2019 actually fell below that long-term average. So again, while we have an expectation of declined farm incomes, they're still expected to be above their long-term average for the U.S. in 2021. Now, as I talked about it, and we have done research on the accuracy of these farm income forecasts. So the red line here are the actual estimates of farm income, and these dots here that we have, they're actually the forecasts, the various forecasts of the farm income and how they ended up as actual. And as you can see, many of these forecasts are actually below the line, which means that forecasts, particularly recent forecasts, are consistently underpredicting farm income. So what we are finding in the first study here that we published last year in the Applied Economics Perspectives and Policy Journal, we're finding an underprediction bias in these USDA farm income forecasts. So the first forecast that we have of the year in February, USDA is underpredicting by about 10%. And as we move more toward their August and their November forecasts, that under prediction bias of 10% kind of reduces to 3%. And obviously, as we move into the next year and they're finalizing estimates, they're getting more and more accurate as time goes on. In our next study that we published in our top agriculture economics journal, which is the American Journal of Agricultural Economics, we're actually suggesting that this bias may be due to high costs associated with overprediction, but these forecasts may still be rational. So now this is overall the bottom line farm income forecast that USDA is putting together. Now, if we are to break it down for various categories, we could be looking into crops and livestock cash receipts. And what we're seeing here is that as the years go on for 2021, we're expecting 216 billion dollars for crop receipts, and we're expecting 175 billion for livestock receipts. And again, we're seeing an increase both in crop and livestock receipts for 2021 as far as the forecast for this year. Now, if we break it down further in terms of selected commodities, we actually see that um, cattle and calves would have an increase, expected increase in cash receipts, and so will corn, soybeans, and dairy products and wheat are going to be stable to slightly declining for 2021. These are the forecasts that USDA put together. Now, zooming now into Ohio cash receipts for selected commodities, and again, we're ending in 2019 here because that's the last year that we have available data. And we saw here in 2019, corn actually came down a little bit, and soybeans also came down in terms of cash receipts. So again, if since we have these commodities in Ohio, and USDA is predicting increases for corn and soybeans. Perhaps, this is my personal expectation. We can also expect to see stronger corn and soybean receipts, both due to higher prices as well as possibly higher yields this year. Now, if we put together Ohio and US corn cash receipts, you can see here that this is the trend line for Ohio cash receipts and for the US cash receipts. And we're seeing that although not perfectly mirroring each other, very much the broader trends are similar in the US and in Ohio. And this is why I'm saying that if USDA is predicting increase in cash receipts for corn, perhaps we would see the same increase here for Ohio cash receipts for corn. Now, same for soybeans. Again, we saw some declines in 2019, but again, if we're to mirror the same trends as in the US, perhaps we would again see an increase in soybean receipts for Ohio in 2021. Now, switching into farm expenses, which are a component of farm incomes, we can see that farm expenses are forecast to increase slightly in 2021, particularly expenses for feed, fertilizer, fuel, interest, and labor are expected to increase. However, if we're looking at net rent here and seed expenses, they're forecast to decline for 2021. So again, overall increase, but with some decreases for certain components. Now, everyone has been talking about government payments, particularly last year. We had a record year in terms of government payments at $46.3 billion. And this year, these government payments are actually expected to be much lower at $25.3 billion, still higher than the historical trends, but much lower than what we saw last year. So this is the expectation as of February of this year. It's So these government payments are expected to decrease by a large amount. Again, would we see the same thing in Ohio? Perhaps, if the same trends continue. But the biggest unknown for this year would be, again, government payments and, how much additional help farmers would receive by the end of the year. Now, let's break down all of these components from what I talked about in the previous slides. So if we start with net farm income of $21 billion, which was the ending income in 2021, what we are expecting is an increase in crop receipts, livestock receipts, and we are expecting a huge reduction in government payments. And that is how we arrive at this lower net farm income for 2021 of $111 billion. So what you see is here, the biggest improvements and increases are in improving crop receipts and livestock receipts. And the biggest decline that drives the overall reduction in farm incomes is these government payments, which are expected to decline significantly. Okay, moving on now with WASDE data sets, and I'd like to talk a little bit about the commodity markets and what we see there. These are the crop yields that we expect for the 2021 marketing year. And we're seeing that corn yields is expected to increase slightly at 122 bushels per acre, and soybean yields are also expected to increase slightly to 50.2 bushels per acre. Now, these are, in general, we have had years with very strong yields, and we haven't had any big droughts or anything like we saw in 2012 in recent years. So while expectations for yields are generally optimistic, um, here is the expectation for production of crops in terms of millions of bushels. And again, that's relying on the high um, yields that we see. So we're expecting to see an increase both in corn and soybeans for the marketing year 2021 in terms of millions of bushels. Okay, so now let's switch to what are the long-term projections of farm income? We talked about the one-year forecast that is as of 2021, as to the end of this calendar year. If we look long-term in terms of the 10-year projections going forward, these are what is called the USDA baseline projections, and they are going 10 years ahead into the future. So what I'm showing here, these are the actual farm incomes that you saw on the previous slide until now, and these are the projections for farm income going into the future. And what we're seeing here is these projections long-term projections kind of are very closely related to the ERS projections, to the USDA projections that I showed you for the short term. So we do expect to see reduction in 2021, and then we expect to see an increase for 2022, and then this curve kind of flattens out after that. So as you can see here, we have a lot of ups and downs in terms of farm incomes over the year. Yet we see that this line here is very suspiciously flat going into the future in terms of 10-year projections. So if I show you the same figure, only I'll show you a few more graphs. This is again the actual farm income that we saw historically. And these are these projections that we had for the next 10 years. Here, though, is all of the previous projections that were being given starting from each of the year and going forward 10 years. Well, if you see here, say in year 2008, here's what the actual value is. And this prediction was that it was going to decrease down and it's going to kind of slowly increase. That's not at all what happened. We saw a sharp decrease and then a huge increase. And the same things here. Even if you see that maybe the first year ahead, 1 year out is somewhat accurate, at least to the direction of the bias, what we are seeing is that um, beyond 2 or 3 years into the future, these projections are very uninformative. In other words, they're as good as a flat line. And this is what our recent research with my PhD student, Siddhartha Bora, and my colleague, Todd Keithy at Purdue, have found is, again, 2 or 3 years in the future, and then these baseline projections become uninformative. Okay, moving on. Let's talk about commodity prices. So what the WASDE forecasts are showing for the 2021 marketing year is seeing an increase both in corn and soybean prices here for the 2021 marketing year. And again, these are not the highest possible prices, but they are expected to be on the rise for this marketing year. Now, in terms of long-term projections of commodity prices, again, these are the historical prices for all of the for the three commodities that I corn, soybeans, and wheat, and these are the projections. And the one thing again that you're seeing here is that the 10-year projections in the future, right here, are very flat in comparison to what the actual values were with the ups and downs throughout the years. These projections into the future are amazingly flat. And so if I show you these, the actual values here, this is the projection, the most recent projection going 10 years forward. But these are all of the historical projections, 10-year projections that we've had. Again, you see that for this year, they thought it was going to come down, the prices, and stay, come down and stay. But they're very far off from what actually happened, which is the blue line. So again, what we are finding in our study is that beyond 2 years, these long-term projections are not very informative. Okay, now switching the point, we talked a lot about farm income, both what happened in the past, short-term projections 1 year, as well as 10-year projections. Now let's switch to the balance sheet of the agricultural sector, and this is the farm assets, farm equity, and farm debt. So what we are seeing here is that farm assets, equity, and debt are forecast to increase slightly in 2021. If we look at percent changes from last year, here is the percent changes that we see for this year, 2021, as far as forecasts. And we're seeing that farm assets and farm equity are expected to rise by 1.8%, and farm debt is supposed to rise by 2.2%. So it's good that there are positive rates of increase for farm assets and farm equity. However, this is pretty much at the pace of inflation. We don't have these huge increases in farm equity and farm assets as we saw in 2013 and 2014. Um, and again, we see that year after year, what we see is that the growth of farm debt outpaces that of farm assets and farm equity. Okay, so now let's turn into farm assets by type. So if we're looking at farm real estate assets, they represent 82.6% of farm assets. So when we talk about farm assets, we're mostly talking about farmland as they are the overwhelming portion of the uh, balance sheet for the farm sector. So what we are seeing here is an increase in uh, farm real estate in terms of the forecast for this year, and that drives up the overall increased uh, predictions for farm assets. Okay, so talking more about farmland, let's look at the cropland values, farm real estate value, and pasture levels. This is for the US. The most recent data comes from NAS that we have, and data is as of September 2nd, 2020. And what we saw last year, as of August and September, is that cropland values remained stable at 4,100 per acre, same as the previous year. So it's showing very stable land values in the U.S. as of last year, despite the beginning of the pandemic. What we saw here for Ohio is the cropland values increased by 0.9% to $6,460 per acre in 2020. So it was a slight increase from the previous year. Now, if we look at the map of all of the cropland values by state, what we're seeing here is that cropland varies show tremendous amount of variation from one state to the next, and that Ohio land values actually remained higher than the national average. This has always been the trend. Now, um, if we look in terms of changes in cropland values, we are actually seeing that in 2020, we saw a lot of the Midwest states here posted either flat or small decline in cropland values. And Ohio land values were slightly better than other states in the Midwest in terms of 0.9% increase. Okay, so now let's talk about cash rents. And cash rents in the US decreased by 0.7% to $139 per acre in 2020. So there was a little bit of reduction there. Ohio cash rents, on the other hand, increased by 0.6% to get to $156 per acre in 2020. So here is now the map of cash rents, and I'm looking again at Ohio, and of course, cash rents in the Midwest are amongst the highest in the U.S. because of generally more productive land. And again, Ohio had $156 per acre as far as cash rents. In terms of percent increase and decrease, here is last year we saw a lot of decreases here in cash rents, also decreases right here in Illinois. Last year, Ohio had 0.6% increases in cash rents. So this is the one surprising trend about cash rents in Ohio. They show an amazing amount of what we call stickiness, which means that when prices come down, cash rents do not want to come down. So here is this is better illustrated on this graph where we have cropland values. This is Ohio and this is US. And this is the cash rents in Ohio and the US. And so notice that as farm incomes and crop prices started falling down here in 15 and 16, cash rents in the U.S. also followed suit and then fell down as well. But cash rents in Ohio did not. So again, we have cash rents in Ohio being considerably more sticky than those in than those of the US, as they're not coming down despite a uh, lower cash rents in the rest of the country. Okay, so now moving into financial stress, let's look at some of the financial ratios for farms. So the last data is from the USDA Agricultural Resource Management Survey, and this was basically the 2019 2019 financial ratios. So for farm liquidity, we're looking at the current ratio. Current ratio is current assets divided by current liabilities. So as of the end of 2019, they were very similar to each other. And typically, a current ratio of 1 or 1.5 are considered on the borderline. So with ratios of 2.3 or 2.2, these are very stable ratios. So we could conclude that most farms have had sufficient liquidity. Now, there's some vulnerable farms, a small percentage that may experience liquidity problems, but overall, the farm sector shows sufficient liquidity. Now, in terms of farm profitability, what we see here is that farm profitability ratios are measured by return on assets, return on equity, and so they continue to decline both for the US and for Ohio. But what you see here is that Ohio saw much steeper declines with negative profitability for Ohio farms. So if we look across the country, profitability is the most problematic ratio. So again, as I talked about, farmers have good liquidity, but profitability is always where farms have trouble with, particularly if it's smaller farms. They are consistently year after year not able to make sufficient returns on their investment. And again, what is reasonable? It depends on whether you own the land or rent it. But it's hard for any business to sustain themselves with rates of return that are close to zero or even negative. So in terms of farm solvency, the last few years have been generally stable, and they show they're still historically low. Farm solvency, as far as debt to asset ratio, also decreased sharply for Ohio farms in 2019. But in general, having indebtedness of about 6 to 9% for the U.S. farm indicates that again, solvency is very good on average in the farm sector. Although again, some select farms may have higher indebtedness, which puts them at higher level of financial stress. But overall, we don't see very high increases in solvency across all farms. Now, let's continue with the agricultural loans and what we saw in the last quarter of 2020. And so here is the agricultural loan volume for all of US loans. And what we saw here is a slowdown in what we have in terms of agricultural loan volume out there. So we had that agricultural loan volume decline slightly to 174.5 billion dollars in 2020 as of the last quarter of in 2020. So this is actually overall for the whole last year. And what we're seeing here is the breakdown between the real estate loans, the volume that goes into real estate loans and production loans. So these real estate loans, these are the long-term loans financing farmland, and these are the short-term operating loans that are only a few years, a year, 2, 3, 5 years operating loans, production loans. So again, more real estate loans versus production loans. If you look at this situation for Ohio, what we're seeing here is again, we're seeing this slowdown of agricultural loan volumes in 2020. And that's perhaps due to higher farm incomes that we've had last year. So farmers needed less loans or they repaid more of their loans. So this is the reasons for the slowdown in agricultural loan volumes. And this is the quantity of real estate loans and production loans. So what you see here is that Ohio farmers have proportionally much more real estate loans than US farmers, which is indicative of them holding more farmland. Okay, now switching into what does that mean for agricultural loan delinquency rates by loan type. So here is the final numbers that we have here. And agricultural loan delinquency rates have remained relatively low at 1.8% in 2020. So here, as farming, if farm incomes are down, we see like reverse relationship. As farm incomes are down, the delinquency rates go up. And here, and what we're seeing here in the last few years is this a slight upward trend in delinquency rates. So a slight upward trend, not as high as they were in 09, 10, and 11, but a slight upward trend. And what we are also seeing here is these upticks and downticks. These are basically quarter by quarter data, so there is variability in terms of delinquency rate by quarter. Another interesting thing to notice is that the real estate loans that we have here, they have much higher delinquency rate than production loans that we see here on the bottom. And again, this is because these are the much larger loans, real estate loans that have also uh, much larger and longer term loans that we have. Now, if we look at the Ohio versus US in terms of agricultural loan delinquency rates, what we are finding here is that these are delinquency rates here for the US and these are for Ohio. So Ohio has had slightly lower delinquency rates for US loans. So that's good news for Ohio farmers and Ohio lenders. And that is true as of the last quarter of 2020, which is the most recent data that we currently have. Now, looking across, spatially across the whole US, most of the loans, agricultural loans, they're actually focused right here in the Midwest. But yet, what you're noticing here is that the delinquency rates are actually relatively low in the Midwest. So, if you notice, the delinquency rate for the whole US is 1.6%, same as Ohio. Uh, uh, during 2020. So Ohio, again, right on par with the US in terms of delinquency rates for 2020. Now, if we zoom in this map a little bit more and show you delinquency rates by county in Ohio, this is the map that we have. And again, there are some pockets of Ohio counties that have had elevated ag loan delinquency rates, and some of them that have had much lower delinquency rates. So these are the delinquency rates by county in Ohio. Now, this is the situation with agricultural loans and delinquency rates. Again, what we saw is a slowdown of availability and use of agricultural loans in 2020, but relatively low delinquency rates for 2020. Now, switching to the Chapter 12 farm bankruptcy filings in the US, these are the trends that we see here. And again, you can see a very, very slight upward trend in bankruptcies over the last few years. And you see upticks and downticks for each quarter, but in general, still relatively low bankruptcy filings. So there were 120 bankruptcy filings in the US in the last quarter, in the fourth quarter of 2020. And in Ohio, we only had one bankruptcy filing in the last quarter of 2020. So, Chapter 12 bankruptcy filings have had some recent upticks and downticks, but have remained relatively stable in recent years. So, we are seeing the same thing if we put the number of bankruptcy filings in terms of rates. So, here we have, in terms of rates, we have 2.4 bankruptcy files per 10,000 farms in the US. And in Ohio, we have zero point 0.5 bankruptcies filed per 10,000 farms. So Ohio's rate has been lower than the US rate. And in general, in this last quarter, it was much lower, but in general, it's about half of that of the US. So again, despite some recent upticks and downticks, bankruptcies have also remained very stable in recent years. So if we're looking at these farm bankruptcy filings across different states, this is what we are finding here. In the whole of 2020, we had 10 bankruptcy filings in Ohio, and in the U.S. they were 553 bankruptcy filings. Now, in terms of rates over the last year, the U.S. bankruptcy rate was 2.6%. 2.6 bankruptcies per 10,000 farms, whereas in Ohio it was 1.3 bankruptcy filings per 10,000 farms. So historically, Ohio has had about half of the bankruptcy rates of the U.S. Okay, so these were the individual components that I wanted to discuss. Just to summarize, once again, farm incomes are expected to decline in 2021 after 4 years of very strong growth. And this indicates that the farm economy is showing some resilience, but it still faces many challenges and uncertainties during the pandemic. The biggest question that we have as of now is what would happen to government payments? Those government payments from the Market Facilitation Program and CFAP 2, due to the trade wars and the pandemic last year, significantly helped to boost and stabilize farm incomes, but they're expected to be lower in 2021. So again, it's a question of what will happen with farm incomes this year. Again, USDA is predicting some decline in farm incomes, but again, if there's under prediction bias, perhaps farm incomes are going to be higher, and due to several different factors. But again, one of the biggest uncertainties is also government payments for this year. We're also showing here that the long-term projections of farm income and crop prices show slight increases or decreases and then flatten and become uninformative after 2 or 3 years. So basically, in recent, up to 1 or 2 or 3 years ahead, we could trust those as far as those projections, but into the long future, they are as good as a flat line. Now, farmers do experience some financial stress. I mean, they have relatively strong financial positions in terms of solid assets and farmland values and cash rents. But they are experiencing some stress with recent upticks or downticks, but there's still relatively low agricultural delinquency rates and bankruptcy rates across the board. And everyone is looking into the long-term projections and how we're going to get out of the pandemic. And again, these concerns are regarding the continuation of the ag government aid to stabilize farm incomes and to keep those delinquencies and farm bankruptcies low. So with that said, thank you very much for attending this webinar or watching it afterward. And at this point, I will open uh, the uh, the floor for some questions from participants. Thank you very much all for attending.